Greeting plan sponsors, and welcome to the next edition of Marquette Associates Retirement Basics. I'm Lauren Cellucci, consultant, and I'll be guiding you through the webinar covering recent trends and considerations for your defined contribution plans. Today, I will be reviewing popular trends and topics in the defined contribution world, such as white label 401k investments, custom target date funds, annuities, and recent rulings from the DOL, including private investments and proxy voting. The first trend I'll discuss is white label investments in defined contribution plans. White labeling of funds is taking a single mutual fund option, say Fidelity Blue Chip Growth Fund, and renaming it to the U.S. Large Cap Growth Fund, or taking a funds-of-funds approach, including several underlying strategies and combining into one white labeled fund, such as custom target date funds. The idea behind white labeling investments in defined contribution plans is that you can simplify participant decisions by reducing the number of choices and simplifying names, thus making it easier for participants to understand a fund strategy and improve favorable outcomes. Other possible benefits include increasing diversification by taking a funds-of-funds approach while not overloading the plan menu with too many investment options, control over design, allowing the plan sponsor to customize investment options that most closely align with their investment beliefs and plan demographics. Another benefit is reducing communication challenges. Plan sponsors rely on safe harbor provisions in making fund changes to deliver notices to participants within 30 days of replacing a standalone fund. However, for white label products, notification is usually not required since the white label structure and participant choice remains intact. For large plan sponsors, white label funds can be attractive since they can scale plan investments to reduce total plan costs. Also, with larger dollars being able to move away from mutual funds to less expensive collective investment trusts, otherwise known as CITs. And it sounds like a lot of great benefits, right? So you may assume this is a major trend within plan sponsors. Well, not so fast. According to an Aon study, only 25% of large defined contribution plans are using white label investments. And there's a much rarer adoption among small to mid-sized plans. There's been hesitancy to adopt white label approaches due to, and critics are the first to note, transparency, and claim that participants should easily know specifically of what and who they are investing in. If an underlying fund changes, a participant should have the right to know and understand why. It flies in the face of overall transparency movement within 401k plans, and besides, doesn't passively managed index funds offer clear names that describe their respective strategy. Critics also claim it can cause confusion, frustration, and lack of trust among participants about their employer hiding fund names. Also, there's a perception that white label products may be inferior. Similar to generically branded cereal that is cheaper and often sits on the shelves at grocery stores, white label funds can have similar connotations among participants. Access to performance information is more challenging with white label funds, as new funds will lack a track record. Also, daily price movements are only available on employers' intranet, and public sources of information such as Morningstar are not available. The reporting burden also remains the same, as information will need to be disclosed about underlying investment managers, similar to what is required if just a single fund was offered. As a plan sponsor, it's important to weigh all benefits and consequences of white label funds. You must thoroughly analyze and document your decision-making process. It will be interesting to see if the trend of white label funds gains traction in defined contribution plans, both big and small. Another trend within defined contribution plans is the use of a custom target date fund, which is considered a white label approach as discussed earlier. A 2019 Callan survey reports that 87% of plans use target date strategies, and of those, 17.3% are using custom target date strategies. The custom target date fund is designed for a specific plan sponsor which customizes the glide path, active passive mix, underlying managers, and/or asset classes. In 2013, the DOL issued fiduciary tips on target date funds, suggesting that fiduciaries investigate custom target date funds as a potential better option for their plans. Custom target date funds may be a practical option for larger plans with assets over $100 million and a homogeneous plan population. Plan populations with a wide variance in salary and retirement age, or some part of the population having the benefit of a pension plan while others do not, are likely not the best fit for custom target date funds. The potential benefits of the funds are that the plan sponsor has control over the glide path. If the demographics of a plan differ greatly than off-the-shelf products, a plan sponsor may seek to customize their target date funds. Say the participants also have a defined benefit plan. The glide path can be much more aggressively invested since the defined benefit plan is treated like a bond with a steady income profile. However, an employer whose participants only have a 401k may be in more favor of a conservative approach. Other factors for customizing the glide path include salary levels, expected retirement ages, longevity, and contribution rates. Another benefit is the potential to reduce investment expense by controlling how much is indexed, or achieve better pricing using the same managers across both defined benefit and defined contribution plans. Another benefit is open architecture investing. Custom target date funds allow the plan sponsor to choose best of breed managers in each asset class rather than being stuck with one fund company and their underlying proprietary investments. Lastly, the plan sponsor is more able to add or subtract asset classes over time as they see fit. When considering custom target date funds for your defined contribution plan, it's important to note that costs may actually be higher since you may need to pay additional fees for custom glide path design and management. Administration may be more burdensome since you'll need ongoing management, oversight, and reporting that's more complex than off-the-shelf target date funds. Participant communications will now need to be provided by the plan sponsor, glide path manager, and/or the record keeper. The communications are typically custom and can result in additional costs. There are some obvious benefits to using custom target date funds, but those tend to diminish with smaller plans with participants that have diverse financial needs. Moving on to the next topic is annuities in 401k plans. Annuities are attractive and give peace of mind to participants since the investments provide predictability and steady income for the rest of one's life, much like a pension, and may reduce the likelihood of outliving retirement savings. Also, annuities take the intimidating and emotional decision-making process of deciding which asset class to invest in, allocation, underlying managers, and when to rebalance. The Secure Act passed by Congress in 2019 has paved the way to give plan sponsors safe harbor in offering annuities in 401k plans. In 2019, less than 10% of 401k plans offered an annuity option, according to the Plan Sponsor Council of America. And this is likely due to employers' concerns about future litigation before this act's passing and complexity around the investments. Also, another benefit of the legislation is portability of annuity investments by letting employees who take another job or retire move their annuity to another 401k or IRA without surrender charges and fees. At first glance, this all sounds great, and one would assume there would be quick adoption into most defined contribution plans, right? Well, not so fast. Annuities are notoriously complex, and not all annuities are created equal, especially when it comes to terms, fees, and commissions. Plan sponsors will need to conduct objective and thorough due diligence in evaluating annuity providers, focusing extra on costs, and evaluating the insurance provider's financial ability to pay out future obligations. Participant education will need to be designed to help participants understand higher fees associated with annuity options and any potential surrender charges if they decide to divest the annuity, as well as tax penalties associated with early withdrawals. The legislation is fairly new, so it will be interesting to see how annuities will evolve in 401k plans. Moving on to another trend impacting defined contribution plans is private equity. On June 3, 2020, the DOL issued an information letter permitting plans subject to ERISA to offer private equity investments that are part of target date funds and multi-asset class vehicles. The letter gives assurances that private equity may be part of a prudent investment mix, provided a proper analysis is conducted by the plan fiduciaries. It does not, however, allow participants to direct investments specifically into private equity on a standalone basis. For those less knowledgeable, private equity is investing in companies that are not publicly traded. Historically, larger institutions and wealthy individuals invested in the asset class as it has been an excellent diversifier and has produced higher returns than public equities and fixed income over time. Also, the investments are not in mutual funds, but in limited partnerships, and they tend to be higher fee. Since private equity is traditionally illiquid and does not trade on an exchange, the multi-asset class vehicle holding it will need to adopt features related to liquidity and valuation. The fund will need to be designed to provide liquidity for participants to take benefits and direct exchanges among the plan's lineup consistent with the plan's terms. Overall, a mad dash to adopt private equity into 401k options is very unlikely. While private equity firms are excited about potential new investors, employers less so. Employers will face increased scrutiny with adding private equity due to the risks of these investments, and adding to investments like target date funds will only result in a small portion of the overall fund. Moving on to the most recent topic is proxy voting. The DOL proposed a rule in August 2020 advising plan sponsors to refrain from spending workers' retirement savings to research and vote on matters that are not expected to have an economic impact on the plan. They invited interested persons to submit comments on the proposed rule and received thousands of responses. Based on the comments and complexity of determining economic versus non-economic costs, they ruled on December 11, 2020 that plan fiduciaries do not have an obligation to vote every proxy, and if they do, providing 6 principles for their proxy voting process. The 6 principles are as follows. First, act solely with economic interest of the plan and its participants. Second, consider any costs. Third, not subordinate the financial interests of participants under the plan to any non-pecuniary objective. Fourth, evaluate material facts that form the basis for any proxy vote. Fifth, maintain records on proxy voting activities. And lastly, 6, exercise diligence when selecting and monitoring proxy voting service providers. While the ruling is quite new at the time of this webinar's publishing, some critics are concerned the DOL ruling may weaken the investor stewardship process when it comes to ESG. Also, if you have any interest on implementing ESG within your plan, Marquette also has a webinar series available on sustainable investing. Thank you for tuning in to our presentation Trends and Topics in Defined Contribution Plans. I encourage you to contact your consultant if you would like more information on what was presented today. If you enjoyed this video and want to hear more future webcasts, be sure to hit the subscribe button before you go. Additional information can be sent directly to your email by registering for research email alerts on the Marquette website. Thanks again for watching.